Most people believe markets react to bad news. A bank fails. A headline hits the screen. Confidence breaks. Prices move. That story feels logical and comforting because it suggests markets respond to events we can clearly see. But in practice, markets rarely fear bad news itself. They fear what has been quietly building long before the news becomes visible. By the time an official announcement is made, the real damage has usually already occurred. Slowly, mechanically, and out of public view. Capital has shifted. Liquidity has tightened. Risk has accumulated in places few investors were watching closely. Periods of apparent calm can be misleading. When volatility fades from headlines, it often does not mean underlying pressures have disappeared. More often, it means those pressures have moved beneath the surface, into balance sheets, funding structures, and refinancing schedules that do not change overnight, but do compound over time. This is why financial stress frequently appears sudden, even though it is anything but. The trigger is visible, the cause is not. Right now, many observers are asking whether recent disruptions are isolated events or signs of something larger. That question matters, but it may also be incomplete. A more useful question is whether the financial system has already been absorbing strain quietly and whether we are only now beginning to see where that strain has accumulated. This discussion is not about panic or prediction. It is about perception and about understanding how markets tend to signal stress long before they announce it publicly. In mid-January 2026, U.S. banking regulators closed Metropolitan Capital Bank and Trust, a community bank operating in Illinois. According to the official resolution process, the Federal Deposit Insurance Corporation was appointed receiver after determining that the institution was no longer operating in a safe and sound condition. At the time of closure, the bank reported approximately $261 million in total assets, placing it firmly in the category of a small community bank rather than a systemically important institution. To maintain continuity for depositors and minimize disruption, regulators implemented a purchase and assumption agreement. Under this arrangement, substantially all deposits and certain assets of Metropolitan Capital were transferred to First Independence Bank, a Michigan-based bank. As a result, customer accounts were accessible following the transfer, and normal banking operations resumed under new ownership. Deposits within the FDIC insurance limit were protected as required by law. Shareholders and unsecured creditors, however, were not protected and absorbed the losses associated with the bank's failure, consistent with standard resolution procedures. Regulatory disclosures cited an impaired capital position as the primary reason for the closure. This term is commonly used to describe a situation in which losses, often from loan defaults or asset value declines, reduce a bank's capital below required regulatory thresholds. This action marked the first U.S. bank failure of 2026, following a period in the second half of 2025 during which no federally insured banks were closed. The previous bank failures occurred earlier, with isolated closures reported in January and June of 2025. From a system perspective, the resolution followed established regulatory playbooks used in recent years: early intervention, a weekend closure, immediate transfer of deposits, and reopening without interruption to insured customers. No extraordinary emergency measures beyond existing FDIC authority were announced in connection with this event. The closure of a small community bank is not by itself a systemic event. Its significance lies in what it reveals about broader financial pressures, particularly for smaller institutions operating under current economic conditions. At a first-order level, the immediate impact is localized. Depositors retained access to insured funds, and day-to-day payment systems continued functioning. From a narrow operational perspective, the resolution process worked as designed. The second-order effects are more important. Community and regional banks play a disproportionate role in lending to small and mid-sized businesses, commercial real estate projects, and local development. When a bank of this type fails, its lending activity stops permanently. Even when deposits are transferred to a new owner, credit relationships are often reevaluated, reduced, or discontinued as the acquiring bank reassesses risk exposure. This matters because smaller banks typically operate with narrower margins than large national institutions. Over the past 2 years, higher interest rates have increased funding costs, while the yields on many older loans remain fixed at lower levels. When this mismatch persists, profitability weakens and capital buffers erode. According to supervisory commentary from the Federal Reserve, smaller banks tend to be more sensitive to this type of pressure because they rely more heavily on traditional deposit funding and have less access to wholesale capital markets. This is not a prediction of failure, but an observation about structural sensitivity. Another transmission channel is commercial real estate exposure. Multiple research notes from institutions such as the International Monetary Fund and large U.S. bank regulators have warned that refinancing risk in office and retail properties remains elevated as loans originated at low rates approach maturity. These assessments describe risk concentrations, not confirmed losses, but they highlight where stress is more likely to emerge. As individual bank failures occur, they can influence behavior beyond the institutions directly involved. Businesses may diversify banking relationships. Depositors may favor larger banks perceived as more stable. Banks, in turn, may tighten lending standards further to preserve capital. This feedback loop does not require panic to function. It operates quietly through incentives, balance sheet constraints, and regulatory requirements. Over time, this can contribute to slower credit growth, particularly in regions and sectors that depend on relationship-based lending. In that sense, the event is less about one bank and more about how prolonged, tight financial conditions transmit through the system. It highlights how pressure accumulates gradually and becomes visible only when thresholds are crossed, not because conditions suddenly change, but because resilience had already been reduced. Periods of stress among smaller banks are not new in U.S. financial history, but the conditions surrounding each episode matter more than surface-level comparisons. One useful reference point is the period following the 2008 to 2009 financial crisis. In the years immediately after that crisis, bank failures continued even as the broader economy began to recover. The reason was not new shocks, but delayed recognition of losses tied to earlier lending decisions. Many institutions survived the initial downturn only to fail later as impaired assets worked their way through balance sheets. A second comparison can be drawn to the 2015 to 2016 energy downturn, when falling oil prices created localized stress for banks with heavy exposure to energy-producing regions. In that episode, failures were geographically concentrated and driven by sector-specific credit losses rather than a system-wide funding collapse. More recently, the banking disruptions of 2023 highlighted how rapidly confidence can shift when depositors respond to interest rate differentials and perceive balance sheet risk. That period demonstrated the speed at which modern deposit flows can move, even in the absence of traditional recessionary conditions. While these episodes share certain characteristics, delayed effects, sector concentration, and tightening credit, the current environment differs in important ways. First, the starting point for interest rates is materially higher. This changes refinancing dynamics for borrowers and funding costs for banks in ways that were not present in the decade following 2008, when rates remained near zero for an extended period. Second, commercial real estate exposure today is influenced by structural changes in work and consumption patterns. Regulatory bodies and international organizations, including the International Monetary Fund, have noted that office and retail property markets face challenges that are not purely cyclical. These observations are forward-looking assessments, not statements of inevitable outcomes. Third, regulatory response has evolved. Compared with earlier periods, supervisors now tend to intervene earlier when capital levels deteriorate, using established resolution mechanisms to limit disruption to depositors and payment systems. History in this context does not provide a forecast. Instead, it helps filter emotional reactions. Similar conditions in the past did not produce identical outcomes, but they did share a common feature. Financial stress often unfolded over time, with isolated events appearing before broader adjustments became visible. Understanding those patterns helps place current developments in proportion, neither dismissing them as irrelevant nor assuming they guarantee a repeat of past crises. Rather than assuming a single outcome, it is more useful to think in scenarios. Markets and financial systems rarely move in straight lines. Outcomes depend on how several variables interact over time: interest rates, asset prices, funding conditions, and regulatory responses. Below are three conditional scenarios, not predictions. Each describes what could unfold if certain conditions are met. Bull case, gradual stabilization. If inflation continues to moderate over the coming quarters, And if policy rates begin to ease slowly without reigniting price pressures, then pressure on bank funding costs may decline. In this scenario, refinancing conditions improve modestly. Borrowers facing loan maturities are able to extend or refinance at rates that, while higher than the past decade, are manageable. Credit losses remain contained rather than accelerating. Research from institutions such as the International Monetary Fund and several large U.S. banks has outlined this pathway as plausible if labor markets cool gradually and growth slows without contracting sharply. These assessments describe a potential stabilization, not a guaranteed outcome. Under this case, isolated bank failures remain limited. Credit availability tightens but does not freeze. Consolidation continues, but at a measured pace. Market volatility subsides as uncertainty narrows. Base case, prolonged adjustment. If interest rates remain elevated longer than expected, and if economic growth slows without a deep recession, then stress may persist unevenly across the banking sector. In this scenario, smaller banks continue to face margin pressure from higher deposit costs and legacy low-yield assets. Some institutions adapt through balance sheet reduction, capital raises, or mergers. Others exit through orderly resolution. Commercial real estate refinancing remains a challenge, particularly in office and retail segments, but losses emerge over time rather than all at once. Regulators continue to intervene selectively, aiming to limit spillovers. This is the scenario most frequently described in recent supervisory communications from U.S. regulators. Extended tight conditions, gradual recognition of losses, and slower credit growth. It is not benign, but it is not chaotic. Bear case, stress amplification. If inflation proves persistent and if rates remain high while asset values decline further, then vulnerabilities could compound. In this case, refinancing gaps widen. Loan losses accelerate in concentrated sectors. Depositors become more sensitive to perceived balance sheet risk, increasing funding instability for weaker institutions. This does not require a nationwide panic. Even modest shifts in depositor behavior, combined with declining asset values, can push undercapitalized banks past regulatory thresholds. Policy responses in this scenario become more complex. Regulators may need to balance financial stability concerns against inflation risks, while fiscal authorities face political constraints. Credit conditions tighten more sharply, affecting small businesses and regional economies first. It is important to emphasize that this scenario is conditional, not inevitable. Analysts who discuss it typically frame it as a tail risk, lower probability, higher impact, rather than a base expectation. Why scenario thinking matters. Professional risk management is not about certainty. It is about preparing for a range of outcomes and understanding what would need to change for the outlook to shift. Watching which scenario the data begins to support, rather than reacting to headlines, is often the difference between disciplined decision-making and emotional response. When evaluating whether stress is stabilizing or intensifying, I focus less on headlines and more on repeatable indicators that tend to shift before conditions become obvious. One of the first is Treasury yields, particularly at the front and middle of the curve. Short-term yields reflect expectations for monetary policy, while longer-dated yields reflect growth, inflation, and credit risk. Persistent inversion or abrupt steepening can signal changes in funding pressure and risk appetite. These moves often precede changes in bank behavior rather than follow them. Closely related is the U.S. dollar index, DXY. A rising dollar typically indicates tighter global financial conditions as dollar-denominated funding becomes more expensive. Historically, periods of sustained dollar strength have coincided with pressure on leveraged sectors and institutions that rely on continuous refinancing. Inflation data remains central. Releases such as CPI and PCE, produced by agencies like the Bureau of Labor Statistics and the Federal Reserve, influence policy expectations directly. What matters most is not a single print, but the direction and persistence of underlying trends. Sticky inflation limits policy flexibility. Easing inflation expands it. Within the banking system itself, I watch lending standards and credit availability, particularly through surveys such as the Fed's Senior Loan Officer Opinion Survey. Changes here often reflect internal risk assessments before losses appear in reported earnings. Liquidity conditions are another critical signal. Measures such as money market flows, reserve balances, and short-term funding spreads help indicate whether institutions are becoming more defensive. These shifts tend to happen quietly and incrementally. Finally, I monitor commercial real estate refinancing activity rather than prices alone. Volume, maturity schedules, and renegotiation terms often reveal stress earlier than headline valuation declines. Research from organizations like the International Monetary Fund has emphasized refinancing risk as a transmission mechanism, not a forecast of collapse. None of these indicators provide certainty in isolation. Taken together, however, they help form a probabilistic picture of how conditions are evolving and whether pressure is easing, persisting, or accumulating. This process is less about predicting the next event and more about understanding how risk is moving through the system over time. Events like this tend to attract strong reactions because they touch on confidence, not just in individual institutions, but in the system that supports everyday economic activity. The more useful response, however, is not urgency or alarm, but clarity. What we are observing is not a single failure defining the outlook. It is an environment shaped by higher interest rates, slower credit creation, and gradual balance sheet adjustment. These forces work over time. They do not announce themselves with certainty, and they do not move all at once. For investors and observers, the discipline lies in distinguishing between what has already occurred, what is being assessed by regulators and analysts, and what remains uncertain. Markets reward patience far more consistently than reaction. This is not investment advice. It is simply how I am reading the data and the structure of the system at this moment. Risk management, diversification, and time remain the most reliable tools in periods like this. Conditions will continue to evolve, and the signal will come from the underlying indicators, not from the volume of headlines. Staying grounded in process rather than emotion is often the most effective advantage an individual can maintain.